In 2008, housing crashed and took down the global economy. In 2026, commercial real estate might crash and take down civilization itself. And somehow, we're all just pretending it's fine. Look, I'm not trying to ruin your day. But if you think those empty office buildings downtown are just a return to office problem, we need to have a serious conversation. Because what's lurking in commercial real estate makes the subprime mortgage crisis look like a practice round. So 2008, right? Housing market implodes, banks collapse, global recession, the whole disaster movie package. About $16 trillion in household wealth just evaporates. People lose homes, jobs, retirement savings. It was brutal. Here's the thing though. In 2008, the problem was residential mortgages. Houses where people live. Bad, yes, but it was containable because at the end of the day, people need somewhere to sleep. Housing has a floor. You can't just stop needing shelter. Commercial real estate? That's a different beast entirely. We're talking office buildings, shopping malls, hotels, retail spaces. And here's the kicker. You absolutely can stop needing those. In fact, we already did. Fast forward to today. There's $5.6 trillion in commercial real estate debt in the United States alone. That's not total value. That's just the debt. The loans. The money borrowed against buildings that are increasingly empty. And about $1.5 trillion of that debt matures between 2024 and 2026, meaning it needs to be refinanced or paid back. Now, here's where it gets spicy. These loans were taken out when interest rates were basically zero and office buildings were 95% occupied. Today, interest rates have quadrupled and office occupancy in major cities is sitting around 50%. Some cities are worse. San Francisco is at 36% occupancy. 36%. Let me paint you a picture. Imagine you own an apartment building. You borrowed $10 million at 3% interest when the building was fully rented. Your mortgage payment is $42,000 monthly, and you're collecting $60,000 in rent. Life is good. You're clearing $18,000 after the mortgage. Now imagine half your tenants leave and never come back. You're collecting $30,000 in rent. But wait, your loan is coming due, and now you have to refinance at 7% interest. Your new mortgage payment is $66,000 monthly. You're bringing in $30,000. You're losing $36,000 every single month. That's not a business. That's a bonfire you're feeding cash into. That's what's happening to commercial real estate right now, but multiplied across thousands of buildings and trillions of dollars. Building owners can't make the payments. They can't refinance because banks look at empty buildings and say, absolutely not. So what do? They default. They hand the keys back to the bank and walk away. Except here's the problem. The banks don't want the keys. What's a bank going to do with a half-empty 40-story office tower in downtown Chicago? Rent it out themselves. Banks aren't landlords. They're not equipped for that. So now the banks are stuck with assets they can't sell, can't rent, and are actively losing value. It's like playing hot potato, except the potato is a skyscraper, it's on fire, and everyone's hands are already full. Now let's talk about who owns this debt. In 2008, the toxic assets were mostly with big banks. Too big to fail, remember? This time, it's different. Regional banks hold a massive chunk of commercial real estate loans. We're talking about the bank on your corner, not JP Morgan. Regional banks account for about 70% of commercial real estate lending. These aren't institutions with trillion-dollar balance sheets and Federal Reserve lifelines. These are banks with $10 billion, $50 billion in assets. When commercial real estate starts defaulting, these banks don't get bailouts. They get acquired, or they just fail. Remember Silicon Valley Bank? Collapsed in 48 hours in 2023. That was mostly about bonds and interest rates. Now imagine that, but it's happening to hundreds of regional banks simultaneously because their commercial real estate portfolios are imploding. The FDIC doesn't have enough money to cover that. Not even close. The FDIC insurance fund has about $128 billion. Sounds like a lot, right? There's $23 trillion in deposits across all banks. The FDIC fund could cover roughly 0.5% of total deposits. 0.5%. It's like bringing a water pistol to a forest fire. Here's an analogy that might help. Imagine you're at a casino and everyone's betting with chips. Suddenly, someone asks to cash out their chips for actual money. The casino goes to the vault and realizes they only have enough cash to pay out 0.5% of the chips in circulation. The other 99.5% are just plastic tokens backed by nothing. That's your banking system. That's where your money lives. But wait, it gets worse. Because commercial real estate isn't just a banking problem, it's a pension problem. Public employee pension funds have massive exposure to commercial real estate. Police officers, firefighters, teachers, all counting on pensions that are invested heavily in office buildings and shopping centers that are now worth half what they paid for them. CalPERS, California's public employee pension system, has about $40 billion in real estate investments. They need a 7% annual return to meet obligations. Commercial real estate is currently returning negative 15% annually. That's not a shortfall. That's a mathematical impossibility. It's like planning your retirement based on lottery winnings, except you're not buying tickets anymore, you're just hoping numbers appear. The total unfunded pension liability in the United States is estimated at $1.4 trillion. That's the gap between what's been promised and what's actually in the accounts. When commercial real estate tanks, that gap doesn't shrink, it explodes. We're talking $2 trillion, maybe $3 trillion unfunded. You know what that means? Your mom's teacher pension, your dad's firefighter retirement, your buddy's police benefits, all getting cut. Not might get cut, will get cut. The math doesn't work anymore. Here's what nobody's talking about, the cascade effect. When commercial real estate crashes, it doesn't just hurt building owners and banks. It destroys city budgets. Property taxes are based on property values. When a downtown office building goes from worth $200 million to worth $60 million, that's not just the owner's problem. That's the city losing tax revenue. Cities like New York, San Francisco, Chicago, they depend on commercial property taxes for 20 to 40% of their budgets. When those values collapse, cities can't pay for police, firefighters, schools, trash collection. The basic services that make cities functional. We're not talking about cutting the parks budget. We're talking about Detroit-level collapse. But in cities that were supposed to be too successful to fail, it's like finding out your salary is getting cut by 40%. Except you can't just move to a cheaper apartment because you're a city and you're made of concrete. New York City's commercial real estate is valued at about $240 billion. If that drops 40%, and it might drop more, the city loses roughly $3 billion annually in property tax revenue. New York's total budget is $106 billion. A $3 billion hole isn't a rounding error, it's a catastrophe. They can't just print money like the federal government. They have to cut services, lay off workers, or raise other taxes. But raising taxes on residents who are already fleeing to Florida and Texas. Good luck with that. Here's the demographic nightmare making everything worse. Baby boomers aren't just retiring from jobs, they're retiring from cities. They're selling their overpriced urban condos and moving to cheaper, sunnier places. The generation that filled those office buildings and propped up commercial real estate is leaving. And who's replacing them? Millennials and Gen Z who work from home, can't afford city rents anyway, and have zero interest in commuting to an office. The entire economic model of dense urban commercial districts was built on assumptions that no longer exist. It's like building a massive infrastructure for horse-drawn carriages in 1920. Sure, people still need transportation, but nobody needs your hitching posts anymore. The office vacancy rate in Manhattan is 16.8%. That's the highest since they started tracking it in the 1970s. And that's Manhattan, supposedly the most desirable office market on Earth. Secondary cities are worse. Houston is at 22% vacancy. Dallas is at 24%. These aren't temporary blips, these are structural changes. Companies aren't coming back. They've realized they can operate with 50% less office space, pay lower salaries to remote workers in cheaper cities, and increase profits. The office building as we knew it is obsolete. Now let's talk about the conversion fantasy. You've probably heard this. They'll just convert empty offices into apartments. Sounds great, right? Solve the commercial real estate crisis and the housing shortage simultaneously. Here's reality. Most office buildings are unconvertible. The floor plates are too deep. An apartment needs windows and natural light. An office building that's 200 feet wide can't be converted because you'd have apartments with no windows in the middle. The plumbing is wrong. The electrical systems are wrong. The elevators are in the wrong places. Converting an office building to residential costs $200 to $400 per square foot. Building a new apartment building costs $250 to $350 per square foot. You're better off demolishing the office and starting over, except you can't afford to do that either because you're already underwater on the loan. It's like trying to turn a submarine into a passenger plane. Technically, they're both vehicles, but the conversion is economically insane. The few conversions that have worked were boutique projects in prime locations with massive subsidies. That's not a scalable solution for millions of square feet of obsolete office space in secondary markets. Here's the insurance dimension nobody sees coming. Commercial buildings require insurance, property insurance, liability insurance, all of it. When a building sits empty, insurance companies get nervous. Higher vacancy means higher risk of vandalism, fire, squatters. Premiums go up, way up. But here's the twist. Many insurance policies have occupancy requirements. If a building falls below 35% occupancy for extended periods, the insurance can be voided. So now you've got building owners who can't afford the mortgage, can't afford rising insurance, and might lose coverage entirely. An uninsured $100 million office building is a lawsuit waiting to happen. If someone gets hurt, if there's a fire, if anything goes wrong, the owner is personally liable. That's why they default and walk away. It's not just financial, it's existential risk. It's like owning a car you can't afford to insure, can't afford to fix, and can't afford to park. But the car is 40 stories tall and in downtown Denver. The total insured value of commercial real estate in the US is roughly $4 trillion. If vacancy rates stay high and insurance costs double or triple, that's hundreds of billions in additional costs landing on building owners who are already drowning. More defaults, more empty buildings, more insurance problems. It's a death spiral. Let's talk about the shadow inventory. Right now, official vacancy rates are bad but manageable looking. 15%, 20%, maybe 25% in struggling markets. But those numbers are lies. Well, not lies exactly, but they're wildly incomplete. A building is considered occupied if there's a tenant paying rent, even if that tenant never uses the space. Companies are still paying for leases they signed in 2019 for space their employees haven't entered since 2020. Those leases expire between 2025 and 2027. When they do, companies won't renew. Why would they? Their workers are productive at home. The office space was a sunk cost they're eager to eliminate. When those leases expire, the real vacancy rate reveals itself. Analysts estimate the true vacancy rate, accounting for unused but leased space, is closer to 0% in major markets. When leases roll off, that becomes official. Suddenly, landlords who thought they had 80% occupancy wake up to 40% occupancy. The revenue collapses overnight. It's like thinking your marriage is fine because you're still technically married, but your spouse hasn't been home in 3 years and the divorce papers are in the mail. The lease roll-off schedule is a ticking time bomb. About $720 billion in office leases expire in 2025 and 2026. The renewal rate is projected to be below 50%. That's $360 billion in annual rental income that just disappears. Building owners were planning on that money to make loan payments. Whoops. Here's the retail apocalypse angle. We've been talking about offices, but retail commercial real estate is equally doomed. Shopping malls have been dying since Amazon became a thing, but COVID accelerated it into hyperdrive. There are roughly 1,100 enclosed shopping malls in America. About 400 of them are functionally dead. They just haven't admitted it yet. They've got a couple anchor stores hanging on, a food court that's half closed, and a parking lot that's 90% empty. These malls have debt too. About $130 billion in commercial mortgage-backed securities tied to retail properties. When the malls finally give up and close, that debt goes bad. Who wants to buy a dead mall? Nobody. The buildings are worthless except as demolition projects. It's like owning a blockbuster video franchise in 2024. Sure, it's technically a business, but it's actually a monument to economic obsolescence. The death of malls kills everything around them. Malls were economic engines for suburbs, provided jobs, tax revenue, and foot traffic for surrounding businesses. When the mall dies, the restaurants nearby close. The hotels empty out. The gas stations lose customers. The entire commercial ecosystem collapses. Towns that built their economy around a regional mall are about to become economic dead zones. And guess what backs the municipal bonds that paid for the roads and sewers servicing those malls? Property taxes. From properties that are now worthless. Let's talk about the international dimension. This isn't just an American problem. London's office vacancy rate is at record highs. Toronto, Sydney, Tokyo, all facing the same crisis. The global work-from-home shift happened everywhere simultaneously. Chinese commercial real estate is in even worse shape. Entire cities built on speculation with office buildings that never had tenants. Evergrande, China's biggest developer, defaulted on $300 billion in debt. Country Garden, another giant, is teetering. The Chinese commercial real estate market is $65 trillion, and it's imploding. When China's real estate market crashes fully, and it will, the global ripple effects will be catastrophic. Chinese developers owe money to international banks. Chinese companies won't be buying trophy properties in New York and London anymore. They'll be selling them at fire sale prices to cover debts at home. It's like watching someone juggle chainsaws while standing on a sinking ship. Sure, the juggling is impressive, but the ship is still sinking. The Bank for International Settlements estimates global commercial real estate debt at roughly $33 trillion. If even 20% of that goes bad, we're talking $6.6 trillion in losses. That's 2008's losses doubled. Except this time, central banks already fired all their ammunition. Interest rates can't go to zero again, they're still climbing back from zero. Quantitative easing is politically impossible after the inflation of 2021 to 2023. The tools that saved us in 2008 aren't available. We're going into this crash unarmed. Here's the personal impact nobody's connecting. You don't own commercial real estate, so you think you're safe. Wrong. Your retirement fund owns it. Your state pension owns it. Your insurance company owns it. Your bank has loans against it. The average 401k has about 1.5% exposure to real estate, either directly through REITs or indirectly through diversified funds. When commercial real estate tanks, your retirement balance tanks with it. That $500,000 you've been building for 30 years. Try $350,000. Maybe less. It's like finding out your life savings were invested in Beanie Babies, except Beanie Babies actually have nostalgic value. Public pension funds are worse. They need higher returns, so they took bigger risks. Some have 5% in real estate. When that loses 50% of its value, the entire fund becomes insolvent. Your pension doesn't get cut by 50%, it disappears entirely in many cases. State governments will try to bail out pensions, which means higher taxes, cut services, or both. Either way, you pay. You lose in the market crash, then you lose again when your taxes go up to cover someone else's losses. The social services you depend on, the roads you drive on, the police who respond to emergencies, all funded by budgets that are about to have massive holes blown in them. The quality of life you've taken for granted is built on a foundation of commercial real estate values that no longer exist. Here's the employment cascade nobody sees coming. When commercial real estate crashes, it's not just building owners and bankers who suffer. It's everyone who services those buildings. Janitors, security guards, maintenance workers, landscapers, food service workers in office cafeterias, baristas in lobby coffee shops, all unemployed. These aren't high-paid jobs with big severance packages. These are people living paycheck to paycheck who suddenly have no paycheck. The construction industry collapses. Who's building new office space when existing space is 40% empty? Nobody. Construction jobs disappear. Architects have no projects. Engineers get laid off. The entire commercial construction ecosystem shuts down. We're talking millions of jobs. The commercial real estate industry directly employs about 2 million people in the US. Indirectly, it supports maybe 8-10 million jobs. When the industry contracts by 50%, that's 4 to 5 million unemployed people flooding the job market. It's like everyone decided to stop eating at restaurants simultaneously. Sure, the restaurant owners suffer, but so do the servers, cooks, dishwashers, delivery drivers, and food suppliers. The unemployment rate in 2026 could easily hit 1.5%. Not because of a recession, but because an entire industry collapsed and took its supporting industries with it. And these aren't jobs that come back quickly. Once commercial construction stops, it takes a decade to rebuild capacity. Let's talk about municipal bonds. Cities and states fund infrastructure through bonds backed by tax revenue. When commercial property values crash, tax revenue disappears, but the bond payments don't. Cities can't pay their bonds, they default. There's about $4 trillion in outstanding municipal bonds. A lot of that is backed by property taxes and economic activity in commercial districts. When those districts empty out, the bonds become junk. Retirees love municipal bonds. They're safe and tax-free. Except they're only safe if the city can pay them. When cities start defaulting, millions of retirees see their income streams dry up. It's like lending money to someone who promises to pay you back with money they're going to make from a job they just lost. Detroit defaulted on its bonds in 2013. Bondholders got 74 cents on the dollar after years of bankruptcy proceedings. Now imagine that happening to Chicago, Los Angeles, New York. The financial carnage would be biblical. Here's the inflation-deflation paradox that's going to break people's brains. When commercial real estate crashes, asset values deflate. Buildings worth less, portfolios worth less, everyone feels poorer. Classic deflationary spiral. But governments will respond by printing money to prevent complete collapse. That creates inflation. So you'll have asset deflation and consumer price inflation simultaneously. Your house and 401k lose value while your groceries and gas get more expensive. You're getting poorer from both ends. Your wealth shrinks while your cost of living rises. It's the worst of both worlds. It's like being on a diet where you gain weight but also lose muscle. You're worse off by every metric simultaneously. The Federal Reserve will face an impossible choice. Raise interest rates to fight inflation, which accelerates the commercial real estate crash, or lower rates to save commercial real estate, which makes inflation worse. There's no good option. Whatever they choose, something breaks. Here's the geopolitical angle. When the U.S. commercial real estate market crashes, it doesn't stay contained. We're talking about trillions in global capital that's suddenly worth half what investors thought. Sovereign wealth funds from Norway, Saudi Arabia, Singapore, they've all invested heavily in U.S. commercial real estate. When those investments tank, their national budgets take hits. Countries that depend on sovereign wealth fund returns for public services suddenly face budget crises. Norway's sovereign wealth fund has about $1.4 trillion in assets with significant real estate holdings. If commercial real estate drops 50%, that's a massive loss. Norway's generous social programs are funded by investment returns. When returns disappear, the programs get cut. It's like everyone bought tickets to the same sinking ship. When it goes down, everybody drowns together. The loss of confidence in U.S. assets will be profound. For decades, global investors saw U.S. commercial real estate as rock solid. Skyscrapers in Manhattan, office parks in Silicon Valley, malls in suburbia, all considered safe investments. When that safety evaporates, trust in American assets generally collapses. Foreign investment in the U.S. could drop by trillions. That means fewer buyers for treasury bonds, less capital for American businesses, economic isolation we haven't experienced in a century. Here's the technological irony. The tools that were supposed to make us more productive, video conferencing, cloud collaboration, project management software, are the same tools that made offices obsolete. We innovated ourselves into an economic crisis. Zoom didn't kill commercial real estate to be evil. It just made it possible to work from anywhere. Microsoft Teams, Slack, Asana, all these platforms made physical offices unnecessary. The technology that was supposed to enhance office work ended up replacing it entirely. It's like inventing a car so good that it bankrupted the highway system. The innovation was great, but the infrastructure built for the old way can't survive. The $5.6 trillion in commercial real estate debt is backed by assumptions from the pre-Zoom world. Assumptions about occupancy rates, rental income, and property values that are fundamentally broken. No amount of innovation can unbuild the skyscrapers or repay the loans taken out to fund them. Here's the timing everyone's missing. The commercial real estate crisis doesn't hit all at once. It's rolling defaults over 24 to 36 months. 2024 was the warning tremors. 2025 is when the earthquakes start. 2026 is when buildings start literally getting abandoned. By 2027, we'll have dozens of major cities with entire districts that are functionally empty. Ghost buildings in the middle of downtowns. Darkened towers that cost more to maintain than they generate in revenue. It's like watching a slow-motion train wreck. You can see it happening. You know where it ends. But there's nothing you can do to stop it. The most chilling part, we're still pretending it's fixable. Banks are extending loans and pretending buildings are worth what they're not. Cities are keeping property assessments high to maintain tax revenue. Everyone's lying to everyone else because acknowledging the truth would trigger the collapse immediately. It's a game of financial chicken. Whoever admits reality first loses everything. So everyone keeps lying and hoping someone else blinks first. But reality doesn't care about pretending. Empty buildings don't generate rent whether you acknowledge it or not. Loans that can't be repaid will default whether you extend them or not. The crash is coming because the crash is already here. We're just refusing to look at it. This isn't a prediction. This is describing what's already happening in slow motion. The commercial real estate apocalypse isn't coming in 2026. It started in 2020. We're just finally reaching the point where it can't be hidden anymore. The 2008 housing crisis was Act 1. The 2026 commercial real estate collapse is Act 2. And unlike sequels, this one's going to be way worse than the original. Look, if this video made you even slightly uncomfortable, good. That means you're paying attention. Most people are sleepwalking into this disaster. Don't be most people. If you want to stay ahead of what's coming, hit that subscribe button. I'm breaking down the economic catastrophes nobody else is talking about while there's still time to prepare. New videos every day on the financial apocalypse the mainstream media won't touch. And smash that like button if you appreciate someone actually telling you the truth instead of feeding you hopium. The algorithm buries content like this because it's not advertiser friendly to tell people their retirements are evaporating. Drop a comment and let me know. Are you positioned for this crash, or are you still pretending everything's fine? I read every comment, and honestly, some of you have insights that are better than anything the so-called experts are saying. Share this with someone who needs to hear it. Your buddy who keeps talking about his real estate investments. Your parents who think their pension is safe. Your friend who works downtown and thinks their job is secure. They need to see this. This is the wake-up call. The alarm's been going off since 2020. Most people hit snooze. Don't be one of them. I'll see you in the next video, where we're diving into what happens to your personal finances when the banks that hold your mortgage start failing. Spoiler alert, it's not pretty. Until then, stay informed, stay prepared, and whatever you do, don't trust anyone who tells you everything's going to be fine. Because it's not.